Do a quick compare and contrast between invoice factoring and bank loans. I mean, if you have a business, you might want to really think about your funding capacity, your capability. So, invoice factoring actually is a great way to actually finance your business. Okay, so here are the general facts here. The thing is, when you think about invoice factoring versus bank loans, it's important to understand that you got to look at the fees, but most importantly, the availability of cash real quick. The thing is that invoice factoring is faster than bank loans, especially if you don't have a relationship, let's say an existing relationship with the bank where you are applying for a business loan. Because what will happen here is that banks nowadays want to have a relationship with the borrowers before they actually release funds or even approve loans for that matter. Okay. And one thing for sure, your business will need capital to start or even operate, because the whole thing is that you always have this timing difference between when your customers are paying you and when you are paying your bill. So you always have this sort of delta where you have to really find ways to plug whatever liquidity holes that you have. Okay. So I'm not going to tell you what a bank business loan is, because you certainly have a clear idea about what a bank business loan is. But I want to talk about invoice factoring. So invoice factoring actually uses your existing invoices as collateral. Very important to remember that. So basically, your accounts receivable are basically your assets. I mean, those assets are already part of your balance sheet on the short-term asset side. But what will happen here is that the invoice factoring sort of company, the invoice factor, will use those existing invoices as collateral. So if you have, let's say, if you have outstanding invoices due from your customers, you can sell those invoices to a third party for a discount. For instance, basically, instead of having like if you have customers owing you $10,000, the factor the company will pay you $9,500. So that they'll take 5% as a fee. So cool thing is you'll get an immediate injection of cash, and your customers will pay the third party directly for the invoices sold. So that's a win-win situation when you think about it. Okay. Now, when you think about invoice factoring, you have other types of funding options. You have a line of credit. You have you have equipment financing, and you also have merchant cash advances. So you have a lot of possibilities when it comes to funding your business, especially in the short run. Okay. So one thing for sure, remember that there is a cost to invoice factoring. I mean, there's a cost to a loan. The cost to a loan, that's actually the APR, in addition to the origination fees and the admin fees, if any. But invoice factoring is actually a factor. There's a discount that the company takes. So when you think about invoice factoring versus bank loans, you gotta really sort of weigh the pros and cons of each option. So I want to talk to you about the advantages of invoice factoring. So when you think about invoice factoring, you have several advantages. For example, you have no incursion of debt or compound interest. In other words, you don't have no new debt on your company's balance sheet, and the process is very quick and simple in terms of approval, because remember, your accounts receivable constitute the collateral that the company is using to grant you the advance, grant you the loan, because it is actually a funding source, by the way, but you are actually funding your own operations. You have fast funding, so you'll be able to capitalize basically your business real fast, and you can leverage your customers' credit. Okay, so the thing is, you have to understand, banks wants to protect themselves financially, so it's really understandable that they only lend to businesses and individuals with a high credit score. In other words, high credit score not only personally but also business-wise. So your paydex score has to be high. So if your customers have a very high paydex scores, that's really good too. Okay, in addition to the personal credit score too. And when it comes to invoice factoring, because the accounts receivable constitute the primary, like the underlying collateral, there is no strict upper limit. Okay, with conventional bank loans and lines of credit, there is a maximum amount of capital that you can tap into. But with invoice factoring, you can actually get more money for as long as you have invoices to sell from good credit customers. Okay, so what about the advantages of bank loans? Well, bank loans actually are pretty good because you have a lack of dependence on invoices. You have a multitude of options. That's really good, especially especially when you have an existing great relationship with the bank, and you also have a flexible repayment option. So that's kind of cool. When I speak about a multitude of options, I'm speaking here about regular loans, so installment loans, business lines of credit, for instance, equipment financing arrangement, among others. That's kind of cool because you really have a flexibility there, and you also have scalability. In other words, you can actually borrow as much as your company's financial position so allows. So when you think about invoice factoring versus bank loans, especially about invoice factoring, there is the element of non-recourse factoring. This is a very important thing to think about. Okay, so when you think about non-recourse factoring, what is it? Well, unlike traditional factoring, in non-recourse factoring, the factor assumes the risk of non-payment by the original debtor. So if the debtor doesn't pay the invoice, the business is not required to repay the factor. So the factor is actually the company to which you sell the accounts receivable, your invoices. Okay. So when you think about non-recourse factoring, here is a method that allows businesses to obtain immediate liquidity without the liability of potential non-payment by their customers. So if your customers, let's say, God forbid, they were having problems later on repaying the invoice, you are out of this. Okay, you got your cash already. So basically, the factor assumes all the risk. Not all companies that offer non-recourse factoring cover the same liabilities. So you can find some things to look out for in many places, especially when it comes to the industry you're in, because your industry you're in will have a different sort of profile from than another industry. Okay. Now, so when you think about invoice factoring versus bank loans, when it comes to the clear winner, it really depends. Really depends. It depends on the stage of development your company is in. So for stable companies with good credit, I want to insist on that. Good credit. In other words, a good paydex score above 80, and also a good personal credit score, not only with TransUnion, Experian, and Equifax. So for stable companies with good credit, a conventional bank line of credit or a business loan are great options for providing cost-effective funding solutions. However, a majority of small and medium-sized businesses are startups, and they have a cash flow gap to fill, and could be in some form of growth mode. So for those companies, invoice factoring provides the ideal working capital solution because they are just selling their own accounts receivable. So if you have outstanding invoices that are as of yet unpaid, if your company doesn't have the credit to take out a conventional bank loan, or if you need funding fast, invoice factoring is a clear winner of this head-to-head comparison. Now, I'll give you the steps later on. So let's talk about the steps here. So how invoice factoring really works. Let me give you a step-by-step here. So what you want to do is you want to contact the factoring company and provide them with information about your business, including your unpaid invoices, credit history of your customers, and the industry you do business in. So your niche, your economic sector. And after that, you fill out an application and the factoring company will review it and match you with the best factor for your business needs. And once approved, you will receive a factoring agreement that really outlines the factoring agreement, the whole agreement, including any fees, factoring limits, and advance rates. So you have all the terms and conditions here. Please review this agreement before you sign. Read the fine prints. And once you have completed the factoring agreement, you can send your unpaid invoices to the factoring company. They'll then verify the invoices and advance a percentage of the amount to you, up to 90%. And the factoring company will work with your customers to collect payment, and then you will receive the remaining invoice amount minus a small factoring fee. So this is an important element to think about. So this is for invoice factoring. How does bank loans or like bank business loans work? Well, you probably have a little idea about it, but all you have to do is to do your research on what bank would be the best fit for your business. Ideally, you want to work with a bank with which you already have a relationship. Make sure you have all your financial documents, including financial statements, tax returns, bank statements. Be prepared to provide information about your business and how you plan to use the loan. Schedule a meeting with a loan officer and at the bank, of course, of your choosing, and be sure to bring in any financial and business documents you may need. Fill out an application and provide all the necessary information about your business, finances, and how much money you are requesting. So I'm talking here about your financial statements, your cash inflows and cash outflows. And the bank will actually review your application and make a final decision. Be patient because this can actually take it depends. It can take days or weeks or even months, depending on the kind of loan that you are requesting. Okay, and if your loan is approved, the bank will provide you with the funding. Read your loan agreement carefully so you understand the repayment terms, and from there, make timely payments to maintain in good standing with the bank actually and avoid defaulting. Let me give you some top reasons here. What are the top reasons why invoice factoring could be actually better than bank loans, especially depending on the industry you're in? Well, first of all, it is quick and convenient. So bank financing options have very strict requirements and require, as you saw a little earlier, tons of paperwork, often making the loan approval process a complex and lengthy one. It can take up to several months for the bank to make a decision. Worse yet, after all that time, the loan may not even go through, leaving you at square one to get cash. So it's a stressful situation if you need a source of cash quickly. In the case of invoice factoring, the approval process is fast via an online application, and the invoice factoring agreement is very simple. As soon as your customer verifies that the invoice is real for the factoring company and confirms that they will redirect payment, you can get a cash advance as quickly as a few business days or even 24 hours. It depends on the setup you have. You also have improved cash flow. So if you can't qualify for traditional loans or lines of credit, but need a boost to your business finances, invoice factoring provides a predictable source of cash and flexible financing. Okay, while many traditional invoice factoring companies require business owners to fund a minimum number of dollar amount of invoices, newer factors allow you to choose which invoices you want to fund whenever you want to fund. So that's kind of cool. So factoring for cash flow actually creates greater liquidity, allowing your business to actually cover your expenses like payroll, buying in bulk from suppliers, or even expanding operations. You can do so in a timely manner and use the additional working capital to take advantage of more opportunities to help your business grow and profit. Okay, and you also have no long-term debt. So this is kind of important because when you think about it, this is actually by far one of the best reason why you want to go invoice factoring. Why? Because basically invoice factoring doesn't create any situation of long-term debt. No more liabilities on your balance sheet. So this is kind of cool. So you have flexibility. Okay, basically, since you are only leveraging the collection of a future customer payment, resulting in an increased cash balance and a reduced accounts receivable balance, you won't have the burden of needing to make monthly payments on a loan. Invoice factoring doesn't weigh on your balance sheet or your mind, enabling you to focus actually on your business. And that's an important element to think about, especially if you want to scale real fast. Okay. If you think about invoice factoring and why it could be better than bank loans, basically there are no caps or limitations. I think I've said this before. Everything revolves around the magnitude, if you will, the amount of your accounts receivable. Okay, bank loans have a maximum amount that can be borrowed. Once you have reached the limits you have been approved for, you have to go through the application process all over again if you need additional funds. Look for an invoice financing company that can give you unlimited capital if you qualify, making the amount of cash available through invoice factoring directly related to your sales volume. If you have like a huge sales volume, that's really cool because the more sales you close, the more invoices you'll be able to factor. And as your business and sales volume grow, you basically you'll have access to even more cash through your receivables. When you have a big opportunity that comes your way requiring cash to pay upfront costs, you'll be able to take it on without worry. Also, invoice factoring is more cost effective because although bank financing is typically less expensive, invoice factoring includes a number of services that can reduce your administrative costs or simply add value to you. Think about it. Many of the best factoring companies complete credit checks of your customers, determine credit limits for them, and collect receivables. So that's kind of cool. So by actually having this task done elsewhere, You have more time back in your day to focus actually on your business instead of, let's say, doing admin work like chasing down a late payment or even doing invoice processing. Think about it. This is kind of crazy. You don't want to do that. Always make sure that any factoring company or factoring services you are considering doesn't actually charge hidden fees or an unnecessary service fee that will drive up your invoice factoring cost. That's because, again, when you think about cost, you got to think about cost holistically as a whole. Also, invoice factoring drives growth when you think about it because, basically, growing requires cash to pay your current expenses along with expenses for large projects or even more customers. And invoice factoring speeds up actually cash flow, so you have that cash whenever you have a chance to grow. You want to seize an opportunity. This type of opportunity happens all the time, especially if you are in a very competitive sector. If your sector is very, very competitive, then you need cash to actually grow real fast. So the thing is, when you think about invoice factoring versus bank loans, the whole idea here is about the growth journey where you are at. It depends also on your credit score and also your financial profile. Okay, it doesn't matter. You can be a startup, but if you are really a cash, if you are filled with cash, if you are awash in cash, then you don't have any problem at all. But if you are actually constantly growing and you need cash to sort of fuel that growth, then actually going invoice financing will be a lot better than actually going with bank loans, simply because the bank loans are actually very lengthy. Once again, unless you have an existing relationship with the bank. See, the whole thing is that this is why I always insist on having an MPR with the bank, so a multi-product relationship with the bank, because see, you can't just rely on the bank to actually finance your operations, your business operations, if you haven't thought about the relationship beforehand. Banks are like individuals, if you will. They love relationships. They want to really build a relationship with you. And so if you are able to build that relationship with the bank before you need financing, that'll be really great. Okay, then you do not have to wait for weeks or even months to actually get your cash. You get your cash faster, but you got to have the relationship. Okay, and also you can actually qualify for a bank loan all the way to $10 million. Actually, I mean, there are banks that have the proper balance sheet to finance those sort of big loans. But again, everything revolves around the relationship you have. Okay. Now, besides bank loans, you have other forms of financing, business financing. So you have like a business line of credit, for instance, where the bank actually gives you puts at your disposal a certain amount of cash that you can tap into to sort of finance your operations. And kind of similar to a credit card, but it's more cash. Okay. You also have a working capital loan. So instead of having an installment loan, you can have a working capital loan. And a working capital loan really is kind of cool because it allows you to fund your short-term activities and have a clear idea about what really works and what doesn't work. And this is also a possibility. But if you have to think about invoice factoring versus bank loans, and you are willing, and see, the thing is, with invoice factoring, you also need to make sure that your customers have good credit. If they have good credit, then you are really good to go. But if they have bad credit or less than stellar credit, then you are toast. So here's the epilogue. In today's conversation, I spoke to you about invoice factoring versus bank loans, and I give you the general facts, the steps, the top reasons, and now the epilogue. Thank you so much. God bless you. I'll see you next time. Until then, remember, stay marvelous.